Okay, welcome everybody. Coming back to you for a second round of the new and improved Who Charted. With me, as always, is Manish Kata. We're going to dive right into it. Some of the most important charts that we see out there right now, and give our take, bullish or bearish.
So, in news that I've probably heard once every 5 years, as long as I've been alive, the dollar is apparently going to implode. Other countries are going to start trading things like oil in different currencies other than the dollar. It's all the hoopla once again, bullish or bearish?
I think this is overblown. So let's call the news flow neutral at best, but probably overblown. But if we just want to kind of take things objectively and look at the trend playing out here for the US dollar index, the trend here is bearish. It's been bearish since October. We're below the 10-week moving average. We're below the 40-week moving average. We're below an important support level at around 102, 103. So keeping it objective, checking the narrative at the door, because yes, we've been hearing about the demise of the dollar for years. I always think it's pretty funny that the most common currency that gets brought up nowadays to replace the dollar is the yuan. Meanwhile, China has yet to unpeg their currency from ours, so I don't see how that one plays out. So let's call the narrative overblown. Let's call the trend here in the dollar bearish.
Buy oil in Bitcoin.
Well, you know how I feel about Bitcoin.
All right, moving on. All right, so far year to date, Microsoft and Apple are both up roughly over 20% as tech and Fang continue to lead this market higher, at least on a year-to-date basis. Participation, leadership, bullish or bearish?
Bullish for growth investors, overblown as a bearish indicator. The bear narrative now is that leadership is concentrated in only a small handful of stocks. Call them the Fang Plus. Thankfully, there's a Fang Plus ETF, so we can go out there and take a look at it. So taking a look at the Fang Plus ETF relative to the S&P 500, yes, it's outperforming. But you know what? It outperformed through most of 2020, which was a good year for the market. It underperformed through most of 2021, which was also a good year for the stock market. So overblown is a bearish indicator. This speaks to performance and not participation. So the bears who are looking at this as a breadth indicator, I think they have it wrong. I'm going to call it neutral to slightly bullish here.
And also, listen, just buy what's going up and solve your problem, right?
I mean, the trend is your friend until the end when it bends, right?
All right. Growing up in this industry, as I have, you read a lot of books from other market gurus, and Martin Zweig is one of them. Winning on Wall Street is his book that I grew up with, and frankly, even at Potomac, we use some of the indicators developed by him around Fed fund rates and whatnot. And so he's kind of a pioneer in this industry. One of his indicators is a Zweig breadth thrust, which has been tossed around a lot recently. I think it's been bastardized to the point where people are changing what the actual inputs are. But apparently it fired, or maybe not. Not sure. Bullish or bearish?
If it did fire, it's bullish. But I think regardless, if you're looking to make a breadth argument, the one to be made is actually bullish here. So this is our version of the Zweig breadth thrust. Now we're using all traded issues on the New York Stock Exchange. So the true definition using that data set did not give us the Zweig breadth thrust, which is the 10-day EMA of advancers over advancers plus decliners, going from under 0.4 to over 0.615 within 10 days. If you're using just equities, it appears to have fired. Regardless, this is the breadth argument, not the previous case with Fang Plus. This is the breadth argument right here. The simple fact of the matter is this speaks to participation in the market. A lot of stocks are going up. So this is a bullish indicator. I am, however, bearish on the term guru within Wall Street. And look, I think this has become bastardized. There are a lot of people that make up their own data sets. And unfortunately, Marty Zweig is no longer with us, so we cannot ask him what the true data set should be. So stocks only, breadth thrust fired, all issues on the NYSE. It did not fire in its strictest definition. However, that 10-day EMA has made a strong move in a relatively short period of time. So if I want to make the breadth argument, I would probably be making it to the bullish side.
I'm going to die on the hill that all issues over common stock every day of the week.
I know you are, and there are people out there who will die on the other hill.
The percentage of stocks that we consider highly correlated has been declining for quite some time. Usually this goes up during market weakness, not down. Bullish or bearish?
I think it's a bullish indicator, especially if you fancy yourself a stock picker, right? We've heard a lot of people talk about just buy the index. You can't beat the market. Largely speaking, sometimes that's true. Sometimes it's not, in my opinion. I think there are times where it makes sense to kind of be an index hugger and recognize that you're not getting paid to be different. And there are times where there are opportunities to be different. And that's where, if you are a stock picker, you should shine. We appear to be approaching that environment right now. What we're looking at here is the percentage of stocks that are highly correlated. And by highly correlated, we are saying that their correlation to the S&P 500 over the past 6 months is greater than 0.75. You can see that was rising through most of 2022, which is a horrific year for the S&P 500, down about 18%. You can see the massive spike in a panic in 2020 when all correlations essentially go to 1. We didn't quite get there, but you get the point. So I think this leans bullish, especially for active managers and stock pickers. If you're going to shine, this line heading lower is the environment for you to do so. So this one falls in the bullish camp for me.
In news that will simultaneously explode the heads of hourly financial planners across the world, gold just hit an all-time new high. Bullish or bearish?
I mean, if you own gold, new highs are bullish. This is a breakout of a consolidation that's been in place for about 2 years. People will argue that this is bearish from an economic standpoint, and maybe it is, maybe it isn't, being a defensive asset, quote unquote. But listen, if you have your allocation to your static allocation, set it and forget it, 5-10% to gold, then this is a bullish development.
Listen, in defense of my hatred of Bitcoin, I hate gold equally as much.
I think that, Bitcoin's digital gold. Get on board, boomer.
Moving on. In a surprise chart, since we do that once in a while, with all the news and who charteds and research reports and everything else out there, the S&P 500 has not moved at all, exactly from this day going back 2 years. Bullish or bearish?
If you're a passive index hugger, it's bearish because, except for dividends, you're likely losing to inflation here. If you are an active manager who pays attention to things like relative strength and focuses on the areas of the market that are leading versus lagging, I think that this is an opportunity to shine. And, if you view the world that way, it's kind of bullish for you from your trading strategy standpoint. But for all intents and purposes, flat is neutral on a real basis. However, it's bearish, and I think it starts to make the argument for being a little bit more active. So bullish for the active managers out there, and a punch in the gut to the passive crowd for now.
And by active, you mean tactical.
Tactical.
All right, with that being said, let's wrap it up. Thank you for joining us today. We got a lot of good positive feedback on the last episode. I think people really like this new format, probably because I'm back in the mix. Smash that like button, subscribe, do whatever you need to. We need to catch up to industry gossip. And that'll do for today. Thank you, and we'll check back in a couple weeks.
Thanks, everyone.